Okay. Got it. Okay, right. And now I'm going to start the webinar. Okay. Hi, everyone that's joining. We're just going to give it a minute or so just to let everybody get in before I make the announcements, and then we'll get straight into it. Okay. 30 more seconds and then I'll start. Okay, right. Hello, everybody, and welcome to today's webinar, which is hosted by tax expert Lee Sharp. A couple of announcements, as always, before I hand over to Lee. If you've been to a webinar before, you'll know what I'm about to say, but just a couple of quick notes. So the first is that we are recording the webinar and it will be shared with everybody by email after the webinar has ended. So look out for an email from us with the link to watch the webinar. The recording is a video recording, so you will be able to see the slides on the video, but you won't be able to download the slides. We don't share the slides separately usually. There are a few special offers to go along with the webinar. So we're offering 40% off the accompanying report, how to maximize deductions for business expenses. So if you'd like more detail on what's being discussed today, you might be interested in ordering the report. Also, if you have any specific questions on this topic or any tax matter, you can have a consultation with Lee. There's a 30-minute consultation for only £97, and I'll give details on how to request a consultation in a moment. So if you're interested in either of those, I will post a link in the chat, which you can click on and have a look. And finally, Lee will be answering some previously submitted questions at the end. You are welcome to ask questions while you're watching, but we normally don't have time to have a look at those. But if there's lots of confusion or questions about a particular topic, then I'll hand that over to Lee and we can see if there's something else that we need to address later. So that's all I have to say. So thank you, Lee, and I will hand over.
Thank you, Isabel. Good afternoon, everyone. Welcome to, I'm not sure whether it's the 8th or the 9th of these webinars, Maximising Business Expenses, 23rd November 2021, which I'm reliably informed is a Tuesday. I apologise if I'm a little bit out of sorts. I've been ill for a few days. I want to thank my wife for looking after me whilst I was on my deathbed, but most of all, I would really like to thank my children for making me ill in the first place. Anyway, without further ado, about this webinar, it's a tax-centric talk, surprise, to cover OMB business expenses. So we'll, the main principles won't change whether you're unincorporated, self-employed, property business, that kind of thing. The topics that we will try and squeeze in, wholly and exclusively does not mean wholly disallowable. Pre-trading or commensurate expenses don't assume they're capital and not deductible. Capital expenditure is not usually bad, just can't claim it straight away. Situations when entertaining and gifts can be allowable. Care with interest relief, a quick look at partnership expenses, back to basics with timing And then if we can, we're going to squeeze in a case study claiming a more expansive claim for use of home as office. Okay. Wholly and exclusively rule, not all bad. The legislation says that in calculating the profits of a trade, no deduction is allowed for expenses not incurred wholly and exclusively for the purposes of that trade. So to simplify that, if there is a private or otherwise non-business objective to incurring an expense, then even if there is also a business justification, the expenditure is not allowable against business profits. We sometimes refer to this as a duality of purpose. There isn't just a single purpose, which is to benefit the trade or the property business. For example, a very well-known case, a company spent money to sponsor the local rugby club. Now that sounds fine. Sponsorship is a perfectly legitimate expense to promote the company's trade. However, it was held that the purpose of the expenditure was at least partly to support the club, of which the company's MD happened also to be a director of that local rugby club as well. And this case is known as Interfish. I imagine the director of Interfish was a little bit gutted when he found out that another very similar case, Southwest Communications Group versus HMRC, heard a year earlier. The claimant in that case won costs from HMRC for a very similar scenario. Interfish, of course, is the one that everybody remembers, and the one that HMRC would like you to remember, not so much Southwest Communications Group. But that is an illustration of the duality of purpose. This idea that if it is to promote the trade, but also the objective was to benefit the club itself, then it becomes not wholly and exclusively. However, the part of the legislation that HMRC focuses rather less time on, the legislation also goes on to say, if an expense is incurred for more than one purpose, this section does not prohibit a deduction for any identifiable part or identifiable proportion of the expense, which is incurred wholly and exclusively for the purpose of the trade. So this is why you get to claim proportions of costs that can be identified as business related, the most common ones being motoring expenses, where you might disallow 25% for private use and therefore claim 75% for business use, telephone likewise, finance costs. This certainly seemed funnier to me when I originally did it about a week ago, but Lord Brightman's Speedos versus stethoscope test from Malou versus Drummond. Some of you may be familiar with the tax case Malou versus Drummond. I imagine almost none of you would be familiar with the Speedos versus stethoscope test, which is basically the idea that if a doctor operating in the UK is required to go and see one of his patients who happens to live in the south of France, conveniently, if he is going purely to attend on his patient and he just happens to enjoy himself whilst he's there, then that is an exclusively business purpose. However, if he goes with the intention of enjoying himself or with the objective of enjoying himself, oh, and while I'm there, I will attend on my patient, then that is not an exclusively business purpose. So what did the good doctor, this hypothetical doctor, pack in his suitcase first? Was it Speedos or was it a stethoscope? That's basically what I'm trying to say. So to give you some excuse me, illustrations, I stop off to buy 20 Benson and Hedges on the way to meet a client. That detour to the newsagents doesn't stop the overall business object of that journey, so it's still allowable, that journey. Alternatively, I bump into a client while shopping and spend 20 minutes giving tax advice. It's still a private, personal journey to go shopping. The fact that I've done a little bit of work is not really relevant to the main objective of the trip. I travel to Liverpool primarily to see a client, but also take the family so that we can make a day of it in Liverpool. Afterwards, it's a single journey, but it has a mixed purpose. Therefore, it's not exclusively business, so it's not deductible from business profits. Now, you might think that sounds just like the Speedos versus stethoscope thing that I've just mentioned, but really it's an issue of priorities. That there's no harm in enjoying the private benefit to what is a business purpose or a business object. But if you make it a composite project or a composite objective, then it will fail that exclusively business test. There might be some expenses on that trip that are 100% business, such as parking to see the client or something like that, where it's incurred specifically with the objective undertaking self-employed or work or similar. And that is why there's that issue about, well, that's that saving about saying if there is an identifiable element or a proportion that is still exclusively business, then that may be claimed. That seemed a lot clearer before. Okay, pre-trading expenses, capital or revenue. Now, I use these words very easily, very freely, and I know a lot of my sort of professional colleagues do, but just to sort of wind it back to basic principles, what we mean by revenue is not income, funnily enough, although it is related to income. It's the expenditure incurred to generate revenue. So it's repairs, stock for resale, wages, salaries, consumables, stationery, internet and office costs, usually deductible against business profits as they are incurred. By contrast, capital is long-term expenditure, assets such as cars, vans, computers, lease purchase of business premises. I don't mean an operating rental thing, because that would be on revenue account. Usually not deductible against business profits, except for the special provisions in relation to capital allowances on certain qualifying expenditure, which would be vans and computers and to an extent cars, and the cash basis, which in theory doesn't really distinguish between revenue and capital, but once you've actually read through the legislation, you will find that despite the simple nature of the cash basis, HMRC has done a cracking job of ensuring that you'll only get relief for capital expenditure that you would have had under the sort of traditional, generally accepted accounting principles basis. Now, HMRC does often review significant expenditure on startup to see if some or all should be disallowed from profits as capital. So you're at quite a vulnerable point at the beginning of your business, because you will be incurring some quite hefty expenditure. This is particularly the case when starting a property business or when buying new business premises for a trade. Renovating newly acquired properties is a classic scenario. And you would be surprised, many of you, to find there's plenty of HMRC guidance that confirms that such expenditure will typically be revenue in nature, not capital, and therefore allowable against business profits. I'm just going to give you a couple of extracts. Business Income Manual 35450. You should not attempt to deny relief from business profits where the purchase price merely reflects the reduced value of an asset due to normal wear and tear. This idea that you've bought a shabby asset and therefore any expenditure incurred to do it up must be capital to give you this brand spanking new or newly rejuvenated asset. Property Income Manual 2030. It may be capital, this additional cost to renovate an asset, if the price paid for the property was substantially reduced because of its dilapidated state. However, a deduction is not denied where the purchase price merely reflects the reduced value of the asset due to normal wear and tear, for example, between normal exterior painting cycles. This is so even if the customer makes the repairs just after they acquire the asset. Now, to be clear, I'm not trying to say that the acquisition of the property itself isn't capital. Of course it is. I say of course, I should have made that clearer. What I'm trying to say is that you will incur, if you incur a significant expenditure to repair or renovate an asset, soon after acquiring it, that repair cost does not necessarily itself become capital, although HMRC will often argue it is, despite its own guidance. Right. Having said that revenue is good and capital is bad, I just want to make the very important point, which is often overlooked. Okay, so you've got business expenditure taken against revenue profits, deductible immediately, which is great, either against income tax at 20%, 40% or 45% for the additional rates, or against corporation tax at 19%, which is soon to become higher, 26.5 in the marginal bracket, or 25% above. If something is denied tax relief because it is a capital expense, it will usually still be deductible when the asset is sold or otherwise disposed of, but you have to remember to claim. If it's a personally owned asset and it's a residential property, for example, the CGT is 28%. So you would want to make sure that you retained all the costs or claimed all those costs that you've incurred as you've gone along, if it's been denied relief against income tax or against business profits. The improvement must still be there, reflected in the asset value at the point of sale or disposal. So, if this is your third conservatory tacked onto the back of, if you've built 3 and replaced 2 conservatories, those replacement costs or those initial costs won't be reflected in the asset on disposal. So the benefits of that enhanced cost should still be there. Now, my recommendation is to try to ensure, not just to remember it, but to add it to the cost of the fixed assets in the balance sheet. Therefore, it doesn't get lost, it doesn't get overlooked. So you don't just disallow it in the tax computations, because that's easily forgotten. Try and get into the habit of ensuring that any sort of significant capital expenditure is added to the fixed assets on the balance sheet. It won't get forgotten then, and it's then your opportunity to review it several years down the line and say, we didn't claim for that at the time, we can now claim for it today and get ourselves some relief against CGT. And one final point, is it better to save income tax today at 20% or CGT, say 2 or 3 years down the line at 28%? As capital is not always bad. Okay, when is entertaining allowable? There's sometimes a fine line between the idea of entertaining or business promotion. We touched on this earlier when we talked about the Interfish case, the rugby, the rugby club sponsorship. And in that regard, there was an issue of duality of purpose, but typically, entertaining is strictly disallowed. Business gifts disallowed under the legislation. But what I'm going to try to set out to you is some examples of where HMRC might think that it falls under the ambit of entertaining, but it doesn't. And actually, there's nothing particularly difficult about this. HMRC has extensive guidance on this, which publicly accepts that these are allowable expenses. So trade exhibition costs or similar are not typically considered entertaining, but promotional advertising. And it's not there in the notes, but there is this concept of quid pro quo. In other words, if you're getting something of value, I mean, if you're doing some promotional stuff and people are coming in and deriving some benefit from, I don't know, a sandwich or something like that whilst they're there, there's this concept of quid pro quo that even if you are ostensibly providing something which would ordinarily or might be considered entertaining, if you are getting something of value in return, and that value is at an appropriate level, then it's not entertaining. It's not a gift, if that makes sense. So filling in a questionnaire, for example, might help you with your marketing and have some value to you, which might then warrant, I don't know, a lollipop or a mouse mat or something like that. Business gifts that aren't food, drink, and tobacco, containing conspicuous advertising and costing no more than £50 per recipient per year. You'll be familiar with this as an idea. You know, the calendar from a stationery supplier or something like that, which will have their logo and contact details on. Incentives, flowers with a new car or buy 3 and get a cuddly toy. This again goes back to this concept of getting something in return. If it's a discount on sales, so the vendor is actually better off as a result of the transaction, then that is not a gift. It's a discount on sale. Likewise, prizes in promotional competitions. Now you can see, if you sort of start to stretch these ideas, then you will ultimately end up on the wrong side of the dividing line between a business gift, which isn't allowed, and something which is, clearly the example given in the guidance, I think, is a bouquet of flowers given with a new car. Clearly, if somebody sold you a car for £10,000, they're covering the cost of the flowers in that sale. The legislation only refers to expenditure incurred, so a trader may supply goods at a discount, but so long as the original cost has been covered, you should not treat the profit forgone as a business gift. Now that's from Business Income Manual 45065. Another thing that I wanted to sort of quickly get onto is staff entertaining. Now, a lot of you will be aware that entertaining employees is typically allowable because it doesn't have that statutory disallowance that you have for entertaining clients or prospects. And you can say, or where you can say, that the expenditure has been incurred to promote goodwill in the workforce, to enhance retention, etc., then that is a trade benefit. It can't be merely incidental to entertaining customers. The thing that people often misunderstand, and I include accountants among this, is that just because it's allowable for tax purposes doesn't mean that it's not a benefit in kind. And what I typically find is that people will disallow employee entertaining from business profits on the mistaken belief that this prevents it from being a benefit in kind assessable on the employee. They're two entirely separate regimes of taxation. And although they have some overlap, it's not a one begets the other or vice versa, or one negates the other. Even HMRC says this quite clearly at BIM 45033. So what you want ideally is employee entertaining that doesn't trigger the benefit in kind rules. So we could have trivial benefits, which is up to £50 per event or per benefit. We have annual staff due rules, whereby you can avoid the benefit in kind employee tax charge. The key points to take away here are, in order to qualify, in order to sort of enjoy this freedom from the benefit in kind charge, there can be more than one in the year, but they must be annual events. They must be recurring events, not one-offs. They must be employees, it must be available to employees generally, or employees at a particular site available. You know, if you've got more than one site around the country or whatever, then everybody at a particular geographic location should be eligible. It's no more than £150 per head attending in the year. So if you invite sort of partners of employees, then that's fine. That will increase the overall spend that's eligible, and virtual events may qualify. Now, said more than one event in a year may qualify. If you have several events, let's say one is £100 per head, one is £40 per head, one is £100 per head, the next one is £60 per head, and the one after that is £40 per head. Now, you don't have to do it in chronological order. So you would sort of bank the £100 per head. You would claim or not treat it as a benefit the latest one that was a £40 a head. That those two combined fall to less than 150. But the 60 quid one is wholly a taxable benefit. You'd then be into Class 1B NICs and probably pay as you earn settlement arrangement. Interest relief for loans, income tax, as distinct from corporation tax. If you borrow for a business purpose, then the interest or finance costs will generally be allowable. The security for the loan doesn't matter. So you can borrow against your private mortgage. You can borrow on or extend your private mortgage, or a proportion thereof. So going back to where it's about wholly and exclusively. So, for example, Sean already has £100,000 mortgage on his house. He borrows an extra 50 grand to buy stock and equipment for his new IT business. From that point onwards, a third of his interest costs will be allowable on basic principles. Whether the interest goes up or down, the fact that the loan is secured on his home, a private asset, is not relevant. However, there are some caveats to this. If you start to take too much capital out of your business, so you put loans in and then you withdraw capital out, then your interest relief may be, or at least start to be restricted. HMRC there there is a case we're aware of where HMRC has tried to restrict relief, where capital removed and replaced by further business borrowing. They've tried to disallow the interest relief, where people have taken capital out of the business and then the business has borrowed to sort of bring funds back into the business, and then claimed interest relief on that additional borrowing. HMRC has tried to deny the relief. That's in direct conflict with its own advice at BIM 45700, but they do say God loves a trier. Take care with borrowing personally to invest in or fund partnerships and LLPs in particular. There are specific rules for investing in partnerships and in particular in LLPs, which means that you won't always get the relief that you would otherwise. There are special rules income tax wise for incidental costs of finance, setting loans up. And special rules for trades under the cash basis. One of the reasons why I loathe the cash basis is that as a self-employed individual, we're not talking about property investment businesses here. The most you can claim finance cost-wise is £500 a year, so it's really ridiculous. Sorry, I just mentioned for corporation tax, very briefly for corporation tax, the last couple of slides are really concentrated on income tax, but for corporation tax, interest and finance costs generally have their own special regime called loan relationships. And as a very broad rule, if you're following the accounts and under UK GAAP, generally accepted accounting principles, then it will be deductible for a write-off, a bad debt, etc. Then it will be allowable for corporation tax purposes. The one thing to be careful about is loans between connected parties. Generally speaking, adjustments between connected parties will be reversed or written back for tax purposes, so you're not better off or worse off as a result of the accounting adjustment in the P&L. However, the rules, the definition of connected parties is not the normal definition for connected parties. It's specific to loan relationships. And it might surprise you how arguably narrow that definition is. Partner expenses. I was confused before I started this. Another area where HMRC appears to be confused or confusing. This is really for the accountants out there who have persevered this long, or people who sort of deal with partnerships quite a bit. There is this idea that for an expense to be deductible in a partnership tax return or for tax purposes, it must be claimed within the partnership tax return. So let's say you've got a partnership of solicitors or GPs, and they incur expenses themselves, not through the partnership's books, but they might have subscriptions to the Medical Defence Union or a law society. They might incur out-of-pocket expenditure for books, for stethoscope, or travelling, etc. The approach has for many years been through self-assessment to sort of take all those personal expenses and drag them up into the partnership tax return, not into the accounts. The accounts will already have been approved; they'll be a done deal. But to adjust the individual partner's profits for those personally incurred expenses. I don't mean private expenses. I do mean expenses incurred for the benefit of the partnership activity. Now, following Vane's v HMRC, which is a couple of years old now, HMRC updated its guidance quite badly. So people thought HMRC was saying that you would only ever be able to claim expenses like that if you actually pull them all the way into the partnership account. So you couldn't have this kind of halfway house where it wasn't in the accounts but was on the partnership tax return. Now they were saying, no, it's got to be in the accounts, otherwise you can't have it. And this could run to several thousands of pounds with larger partnership, professional partnerships, tens of thousands of pounds conceivably. Now this caused uproar. So HMRC then changed its guidance again, said, no, that's not what we meant. No, we didn't mean that it had to be in the accounts, although it could easily be inferred that way. But it does have to be in the return, subject to the usual criteria. But if you look at the example that was in the business income manual, but it's now been moved to the partnership manual 163380. If you that example they've given is as clear as mud to me and to a lot of other people as well. It doesn't help, and I think they should just left it alone. I don't think Baines v HMRC really changed most people's understanding of how the expenditure for partners worked. Okay, so timing is everything. Back to basics now. Let's put partnership expenditure to one side. We usually recommend claiming tax refund expenses as soon as possible. But if profits fluctuate enough so that 1 year we're paying basic rate tax at 20% and the next year we're paying 45% tax, then obviously you want to time your expenditure so that you incur more expense at the time that you're making more profits. Now, that's partly the point of the accruals matching concept anyway, but you do have things like claiming capital allowances or disclaiming capital allowances to however much or as little as you want, so that you can more accurately or better match and make sure that you are not being, as much as possible, you're not being taxed too much in 1 year and not enough in the next, if that makes sense. Again, it isn't just about the obvious income tax brackets. You need to be careful about the child benefit threshold, which is 50k to 60k of adjusted net income, or where you start to lose the personal allowance, where your personal income, adjusted income is 100k to the 120 odd k. These are areas that you want to make sure that you are timing your expenses to avoid being pulled into those kinds of high marginal rate scenarios. And we're about to see NICs and the health and social care levy the year after come in, increasing the effective rate of income tax for many. So we may well see some people being tempted to claim deductions later in some cases, defer claiming capital allowances to a later period to reduce the profits that are taxed at a higher rate. So if we look at corporation tax, it was a very strong case for deferring. The corporation tax rate will be rising from 19 to 25% or even 26.5% marginal rate from April 2023. So companies will be looking to defer their expenditure so that it will save them roughly 40% of that tax bill. The increase from 19, so it's an increase from 19% to 26.5% is 7.5%, and that's roughly 40% of 19%. Bilco Limited usually makes profits of 150 grand a year after incurring maintenance costs of 60,000. In the year to March 2023, which is just before the new rates start to kick in, it deliberately restricts its maintenance cost to £10,000. So it's deferred 50k's worth of maintenance costs. So its profits rise by 50 grand in that year, and it pays an extra £9,500 extra tax. So far, so bonkers. However, it then spends that 50 grand saved later in 2023 to get non-essential maintenance back on track, reducing its corporation tax by 13,250. So net, it saved nearly 4 grand in corporation tax. Now, you probably wouldn't think it was worth it for 4 grand, but if you had a couple of 1, 0 or more on there, obviously that wouldn't still be in the marginal rate necessarily, but you would be saving between from 19 to 25 potentially. So you can make a significant saving, and it's well recognised. But I just wanted to make a nice straightforward point, because these kinds of things are really quite easily overlooked. And so long as Bilco doesn't make safety equipment, surgical appliances or nuclear weapons, everybody's a winner except HMRC. Claiming for use of home as office. Right. The following case study is aimed at people in business on their own account. Self-employed traders, professionals, also property investors, businesses, although strictly simplified expenses don't apply to landlords, and that's something to bear in mind sort of towards the end. Now, when HMRC says that you can claim sort of £10 a month or £18 a month, their logic is wholly based or predicated on the basis that this is mainly a room in your house, so that you occasionally use exclusively for business purposes. So, an hour in the evening kind of thing on your laptop. But when you finish, put your laptop away, it's back to being your kitchen diner, or it's back to being your sort of spare bedroom or whatever. Well, that doesn't really stand up when you consider that they're asking, in order for the princely sum of £26 per month, they're saying, well, you need really to be doing 101 or more hours of exclusive business use a month. That's not occasional. That's most of the time that you're using the property, most of the time that you're using the room. And I would argue that you're kind of flipping it on its head and saying this is mostly a room that I use for business purposes and occasionally for private residential purposes. Just keep that in mind. So last month, we considered the sort of nitty-gritty of capital gains tax on the sale of the home, whether a more fulsome claim to use of home might affect or prejudice or restrict a claim to main residence PPR CGT relief, and the potential of business rates. And we acknowledge that both were in theory possible, but quite unlikely, particularly when all you're doing is using a room in your house, in your home as an office. And particularly given how it's becoming increasingly accepted that working from home using a laptop, a couple of screens, printer, etc. is normal. And that doesn't change the property's essentially residential character. So Mel and Kim each run their own separate, we're in the case study by the way, Mel and Kim each run their separate consulting businesses from their respective homes. So Mel has her business, Kim has her business. Neither of them has other premises, and each uses a spare bedroom at home from which to run the business. When they are not actually physically using the room, they keep their business effects in there permanently. Mel does her own bookkeeping and prepares her own tax return, so she thinks simplified expenses are a good thing. Mel reckons she's entitled to claim £6 per week. She does over 100 hours in her spare room. and that equates to £312 per annum, resulting in a tax saving of 312 and 40%, because they're both high rate taxpayers. That's going to save 125 quid plus NICs. And Kim, it won't surprise you to find, approaches things slightly differently. So Kim has an advisor who asks her to complete the following questionnaire. Now, you don't need to follow all the detail of the numbers on here, but one thing I do want you to appreciate is that there's clearly a more comprehensive assessment of Kim's domestic costs. The simplified expenses are meant only to cover running costs. And if you look, that's heat, light, power, maybe metered water if there's significant use thereof. The £6 a week for purely business use, that is not that far off. But look further down, you'll start to see fixed costs, mortgage interest, or rent if you rent your own home, council tax, domestic insurance. There might even be repairs to the room used as an office, repairs to other rooms, which we'll look at in a little bit more detail, repairs to the home overall. There might be telephone and broadband costs if it's not being claimed already. Okay, so we've got a total of £11,800 of expenses. Now, obviously, that's not all claimable for business. Don't get too excited. And that covers a running cost that we said, but mortgage, interest, council tax, home insurance, repairs, etc. So that's the questionnaire that Kim fills in. The accountant analyses that expenditure. So you've still got a total of 11,800, and you've still got you've analysed that into things that you're going to claim all of. Some things you're going to claim some of, and some things you're going to ignore completely. Now, I've highlighted in red there the running costs come to about 1,380 quid for the entire property. So that is really what the simplified expenses are aiming at as far as HMRC is concerned. So 300 out of 1,380. Redecorating after moving filing cabinets. I'm going to claim all of that because that was an expense incurred directly as a result of running the business in that room. And there's a load of other expenses, mortgage interest, council tax, etc., which relate to the property as a whole. And I'm going to claim a proportion of those. Now, replacing the kitchen, I've ignored completely because it relates to a part of the property that's never used for business purposes, which I think is fair. But where it's an expense on the property as a whole, then I would be entitled, I would be entertaining a claim. So just bear in mind, running costs 1,300 quid, 1,400 quid, fixed costs over 10 grand. Kim has 5 living rooms in the house, a kitchen, diner, a lounge, and 3 bedrooms. Now, Kim isn't using the box room. Who does? But the second decent-sized bedroom. And so whether you do it based on rooms, the number of living rooms in the property, or on floor space, in this case, Kim is pretty much the same either way. It's a fifth or it's 20% of the total area of the living rooms, because she's using quite a sizable bedroom to run her business from. So Kim's advisor therefore suggests, 20% of the £6,000 after carving out the kitchen repair, and then 100% of the £300 of costs directly maintaining her office. Now that totals £1,524. I'm going to discount by 10% to reflect ongoing private use of the room, The remaining 90% is 1,372. So Kim's actual tax saving is 1,372 at 40%. That's 550 quid plus NICs saved, which is more than 4 times what Mel saved just claiming the simplified expenses. Yay. Now, Mel might be a little bit unhappy about this, and she might want to go back and change her claim. Interestingly, HMRC says in its self-assessment claims manual, SACM 12055, Simon, because obviously they don't know who Mel is. Simon is a sole trader who runs his business from an office in his home. Under the simplified expenses rules, use of home, he uses a flat rate deduction of £26 per month to cover the use of his home for business purposes in his 2013-14 return. I don't know which buffoon updated this manual, but my word. After the deadline for amending his return part, Simon realised that if he had worked out the business proportion of his actual household running costs and used those figures instead, he would have paid less tax. Simon, aka Mel, cannot claim overpayment relief. The fact he could have paid less tax if he had made a different choice does not mean the tax he has paid was not due. And there is some validity in HMRC's position about not being able to change a claim after the fact. Once you've claimed it, that's basically it. You find this a lot with capital allowances. Although late claims are possible under the capital allowances legislation, as long as the asset is still owned or in use, you still own the asset in the relevant period. Okay, so politely overlooking the fact the rate wasn't £26 per month in 2013-14, simplified expenses regime that HMRC is promoting, and then saying, "Oh, I'm sorry, you can't have more than that." That's a complete red herring, because really the meat of the claim in use of home is against fixed costs. Simplified expenses regime is supposed to only cover running costs, so those fixed costs are still available to claim. And I did point out to you that the fixed costs actually came to a much chunkier number than the running costs. And landlords can't claim simplified expenses anyway. So if they happen to be claiming £26 per month, that's pure blind coincidence, because they're not eligible to claim simplified expenses. It's purely available under ITOIA to trading entities. So they can't be claimed from any overpayment relief at all. So I would say have at it, certainly for the fixed costs, because that isn't the focus of the running costs simplified expenses claim. So what have we learned? A specific item of expenditure may still be deductible from business profits if any private or non-business element is purely incidental. So, like if I stop off at a newsagent's to buy a pint of milk or a packet of fags, a proportion can be identified, or a proportion can be identified as purely business related. Pre-trading expenditure or repairs to a newly acquired asset are not always capital. You do need to check that you're on the right side of the rules there, obviously. Even if they are capital and relief cannot be claimed straight away, don't forget about them, don't ignore them. You keep them in your back pocket, you put them on your balance sheet, and you wait until you dispose of the asset and say, here are all the expenses that I was denied relief for over the years because they were capital, and I want to claim them now to reduce my CGT bill or corporation tax on capital gains. So you don't have to put them on the balance sheet, but it's practically the easiest way to make sure they're not omitted in the end. There are various scenarios where business promotion entertaining can be allowable, but remember that disallowing staff entertaining does not prevent its being a taxable benefit in kind. This is something I see so frequently. And the rules exempting staff benefits up to £150 per head or an annual limit for annual events. Otherwise, you've got to look towards the trivial benefits regime to save you. Loan interest relief is generally allowable for income tax, but take care if you take too much capital out of your business, as your interest may then be partly or wholly restricted. And I'm warned that HMRC has been known not to follow its own guidance on taking capital out, replacing it with loans and claiming interest relief thereon. The idea being that you can, so long as you have a positive capital account, and that's in its own guidance, but doesn't stop HMRC. Companies have a special loan relationships regime that take care with adjustments between connected parties. Rather specialised issue. Partners' individual expenses for the partnership business have to be claimed in the partnership return. Take care of the expenses disputed between partners. This is the thing, the example given by HMRC, trying to say that, you know, if not all the partners agree for it to be a deductible expense, then it's not deductible, and that is not a condition that is borne out by the legislation, I don't think. Timing. Back to basics, you know, time. You can deliberately defer claiming capital allowances or disclaim capital allowances, so you can claim more later on. And there are some expenses that as a business you have control over, typically maintenance or maybe training or something like that. Obviously, if it's essential maintenance for something important, don't delay it just to save yourself a bit of tax. That's probably not a good idea. And you could argue the training likewise, but there may be some expenses that you can sort of drop the other side of, say, for example, if you're in a company and it's April 2023 onwards, that an expense incurred after that date is going to save you more tax. And finally, claim more for use of home. Please. Q&As. Paul, I have a new client who has his own limited company working almost entirely from home. Home is currently a rented 2-bed flat. Rent, say, of £1,000 per month plus usual costs, heat, light, council tax. He rents out his own PPR hall. What's going on there? He wants to claim unused spare bedroom as 100% office for working and some training activities. What is the acceptable basis for claiming tax relief on these expenses? Right, well, we've just done use of home, but I have to emphasise that is for somebody in business on their own account. If you're an employee, you really are in a different and more difficult scenario. Now, in theory, his company could pay rent. Can't claim rent-a-room relief or property allowance for letting to his own company. It's specifically in the legislation for property allowance that it can't let to a connected company. There is some residual doubt regarding rent-a-room relief and whether or not the legislation actually prevents sort of exempting the income received under rent-a-room, but HMRC is quite vehement in saying that there is no doubt. A company cannot itself claim use of home, but could pay up to a commercial rent. However, he will pay income tax on any profits above his expenses. So you need to be careful there about what you're actually doing and get the sums right. Anything above a commercially justifiable rate would likely be a tax as a corporate distribution, basically a dividend. There are lots of other implications here about, you know, is he allowed to sublet? What does his insurance say, etc., etc. Alternatively, he can be reimbursed as an employee up to £6 per week under home working arrangements, or more if it can be proven that his employment-related expenses justify it under ITP 2003 section 316A. The option to claim relief independently of home working arrangements, this is a specific regime, subsists for 21-22. So this is not being reimbursed. This is me making a tax claim to HMRC on my tax return or similar. Under the pandemic, the current rules have been relaxed under the pandemic, but will revert to the standard approach, which is section 336, which is a notoriously high bar. One thing I did want to sneak in, Paul, is that he currently appears to be sacrificing PPR relief for CGT purposes at the moment. And so I hope his former main residence that he's letting out is not appreciating greatly in value right now. It cannot generally be his main residence while it's being let out, although absences are permitted in some circumstances. You do need to be careful about your planning there. Steph, 2 questions about expenses, as I'm new to this. Please, can you explain what to do about claiming for the cost of electricity at home when it's used as fuel to charge an electric hybrid car, but not easily separated within the household electric bill? Well, we're all new to that. Please, can you tell me where to put the costs of items necessary for the office at home, like storage, stationery, chair, desk, etc.? So, Steph, I'm assuming here you're a self-employed trader, not a director employee, you're not VAT registered, you're not using a cash basis so as not to limit your interest cost to £500 a year. You could claim a proportion of charging your vehicle business miles to total miles. So that is effectively logging all your business miles, and as a fraction of your total mileage covered in the year or period in that vehicle, you claim the corresponding proportion of the costs of fueling the car with electricity. And you can work out that cost, because actually all battery cars will have a capacity, 40 kilowatt hours or 70 kilowatt hours, etc., etc. So you could work it out. However, that doesn't necessarily cover the loss, the inefficiency in that cycle. How many kilowatt hours are you burning through to actually fill up your car, as it were. It may be far, far easier, as long as you're not already claiming capital allowances in that vehicle, to just claim the mileage allowance, 45 pence per business mile, first 10,000 miles. That's a pretty substantial sum. And you could find that you still have to keep your business log, your log of business miles, but I think you might find that is a much easier approach. The office expenses strictly phone, fax, stationery, their office costs, self-employed trades and professions. The rules differ for property businesses. Fixed assets that you mentioned, chairs and desks, not strictly claimed as annual expenses, but they can be subject to the capital allowances claim. If your turnover is less than 85k per year, then you can use a single aggregate figure in the self-employed short form, which is box 20. You may benefit from speaking to a qualified advisor about setting up in business. Andrew, are sponsorship payments to support local events always tax deductible? No. See into fish. I'm not aware of any special treatment for sponsoring local events. There used to be something to do with local charities. That's long gone. Ex-statutory concession B7. Other than the logic, when it might be easy to demonstrate a business rationale. So obviously, if you're sponsoring a local business, this is a business sponsoring a local event, then it might be easy to demonstrate that you're benefiting from it because you're raising a profile amongst local customers and maybe local contacts, etc. Sponsorship implies promotion, advertising, which is of course a valid business purpose. But sponsorship can also potentially fall into non-allowable entertaining and or private business aspects. So depending on the scale of the payment and the relationship of the payer with the payee, is it like, I happen also to be a director or trustee of the entity that I'm sponsoring. HMRC might want to know if the business owner derived any possible personal benefit, dual purpose, therefore not allowable. That's the risk, I would say. And there we have it. Much more detail on the nitty-gritty of claiming expenditure in the report, which is here. Thank you very much, and over to Isabel.
Thank you so much, Lee, for doing the webinar even when you weren't feeling very well. I'm sure lots of our viewers can empathise with that. And thank you everybody for attending today. This is our last webinar of 2021. So if you have attended and watched every webinar, thank you so much for doing that. We really appreciate your support and we hope that you've enjoyed them. Look out for an email from us early next year, with details on, what webinars we'll be doing then. And as always, if you've got any questions, please email support@taxinsider. I've posted the link in the chat for more information on our offers, and I really hope that everybody has a happy holiday and a happy new year, and we look forward to seeing you next year. All right, thanks, Bea.